We all love debt. Debt helps us our dreams come true. First paycheck I got, I put down a down payment on a Porsche. I did not have the cash for it. Too bad. But the bank was happy to give me a loan, given that I had a stable job. The Porsche was the best investment I ever did in my life. Who cares a bit about liabilities if you're having fun? Look at this company. Very successful. 10% return on sales and 10% return on assets. The company has no debt. They sell and then they make a very nice 10% net margin. Now, we are a greedy bunch. How can we make more money? Well, by opening another business, more stores. If one business is making us nice profits, why not open another one, and even another one after that? Debt helps us do that. Imagine we borrowed another $1,000 at 5%. We are making 10% a year. So paying 5% of interest still leaves us with another 5% for us. With $1,000 in debt, we buy thousands of assets. Now our assets grow from 1,000 to 2,000. The new sales are 2,000. And now interest expense is 50. So our net income is now 150. As you see, ROS and ROA are now lower and are 7.5%. They used to be 10% before. However, our ROE, which was 10%, is now 15%. Shareholders are making more income based on their investment. How does that happen? It happens because we are letting other people, bankers, pay for our business. Debt is good. Debt makes us buy things. Debt makes us richer and happier. But debt also can lead us to bankruptcy and can make us worried. Debt increases our stress. Debt is not for everyone. Debt is for those who love risk. And debt can also make us sad. When we borrow money, we record cash, a bank loan, and they're under the cash flow financing, the CFF, we record a positive cash inflow. When we borrow money, we are not poorer, and our equity is not less. When we borrow, there is no negative effect on the income statement. The effect on income and equity comes later. In the next period, we have an interest expense. Interest expense is essentially the cost of renting the money. We take money, we use it, and we return it. It is like renting. The interest expense is an expense on the income statement. We have a mustache, where both equity is less and the CFO is less. Interest is getting paid yearly, so it is a cash outflow under the CFO. Now, please note that in the US, the interest expense is under the CFO. But in Europe, companies can put it under the CFO, but they also can put it under the CFF. As if accounting was not confusing enough, the Europeans give us even more choice. In the last year, we pay back the loan, and you pay interest for the last time. When we pay the loan back in the 10th year, the CFF is a negative 1,000 because we paid the cash back. We also reduced the loan value since we paid it back also. We have no more liabilities. Our cash goes down. Now think of another example where we borrow money, but we do not pay the interest back yearly. We pay all the interest in one lump sum at the end of year 10. Here the accounting is a bit different. Each year we record interest expense and we have the mustache. Net income is lower under the CFO, but we did not pay the interest. So there is a positive adjustment of change in interest payable, and the CFO comes down to 0. In the last year, we have to pay the debt back, and we also have to pay all the interest in one go. So 1,000 to pay the debt back, and 1,000 to pay the interest. Now we reduce 2 items from liabilities. We reduce the debt, and we also reduce the accumulated interest payable. The interest payable is now under the CFO, and it is a total of a minus 1,000. The debt paid back is under the CFF, and it is minus 1,000. The total cash under assets is minus 2,000. Please note that the effect on income of that year is only a minus 100. And that is for the year's interest expense.